Okay, I'm very excited to be talking with Tao Wang. Tao is a managing member of Alpha Architect. There he works on the trading department. He deals with quantitative research. He deals with actually all sorts of research in choosing stocks. A lot of times people today, they say, oh, who chooses stocks? You just buy an index fund. But the basics of investing is buying stocks. That's what people start with. So Tao, I want to ask you about the very basics. How should someone who wants to invest in the stock market, how should he start to find a stock to invest in?
Yeah, I would recommend people start with looking at systems. The way I say that is you want to start with what kind of preference you wanted to have towards investment. Like, do you want to be a value investor? Do you want to be a growth investor? Or do you want to be a momentum investor? And then look at the evidence and then see what works in the past and what does the evidence say about value, investment versus growth investment. And everybody knows that value beats growth in the long term. So you probably don't want to get into, systematically.
I don't know, them is fighting words.
Systematically invest into those growth stocks, even though some of them might sound really good. You don't want to systematically do that. That's what I would say.
So I can tell from your sentence you are really a value investor, because there are certainly growth investors out there who would disagree with you. But that's okay, because you have Warren Buffett in your corner, so you're allowed to say that. What is it about value? Well, let's first define what this means. My understanding of a value investor is, guy's a good shopper. The same guy who would be a value investor would be the type of guy who would go to the store, he'd see a shirt for $50, and he says, I know that's a $90 shirt. And he would buy it because it's a good deal. How are you supposed to really identify that, given that there are thousands of stocks out there? And, where do you start?
You're going to basically start by ranking all the stocks based on some sort of measure. You can use book to market, you can use EBIT yield. Basically, you can break them down by quintile, quartile, or decile. And the cheapest top 10% with the highest EBIT yield or highest book to market is your value bucket. And the opposite would be your growth bucket. And you want to basically systematically invest into the cheapest stocks. Picking any one or two from the cheapest bucket, you're going to suffer from idiosyncratic risk by going with one or two. So you want to kind of diversify a little bit, hold like 30 to 40 stocks, and hopefully you're going to be compensated by taking that risk.
So if you break down the list, you said, for example, you could look at price to book. That was one of the numbers that you suggested?
Yes.
So what that means is that all companies have what we would refer to as a book value, meaning if you kind of liquidate the company, it's worth, $9 a share of stuff, right? That's what we're talking about. Correct. And the stock might be trading at $18 a share. So if it's trading at $18 a share, and the book value, meaning just the value of all, the coat racks and the desks and the buildings and the intellectual property is $9 a share, we would say that this stock is trading at 2 times its book value. And if you're a value investor, you might say that's good. Why is that specifically not growth? Because wouldn't a growth investor, wouldn't he consider also the book value of a stock?
It's just in the academic world, people identify growth stocks by looking at the lowest book to market value. And people see value stocks as the highest book to market value. Like, for growth investors, they definitely would look at the book value of the stock, but they tend to put a lot of weight on the growth, on the price. And because market is kind of efficient, so if you think it's a great stock and growth stock, the price is usually very high. So people are excited about that stock. Like, Tesla, Amazon are great examples of growth stocks. I'm not saying those are bad companies, bad investments, but systematically invest into growth stocks historically doesn't work.
We're talking with Tao Wang from Alpha Architect. He's an expert in stock picking. I want to get one more definition you started before. You differentiated between value, growth, and momentum. Are you differentiating between growth and momentum stocks, or are they in the same bucket?
Yes, that's actually a great question. A lot of people are confused. Like, why would you, you guys are value investing, and also you guys are backing up this momentum investing, philosophy. Aren't they the opposite? Because, value investor is the opposite of growth investing. And then people think growth investing is the same as momentum investing. And they're not the same, because what defines a growth stock? You look at the book to market, some sort of value measure. And if it's high book to market and, it's growth stocks, you look at the fundamentals. But momentum is purely price driven. what defines a good momentum stock is they perform super well over the past 12 months, relatively well than their peers. So they're different, and also we look at the data. Historically, there's only 27 overlap between growth stocks and momentum stocks. So definitely,
27% overlap or 27?
Yeah, 27% overlap. So they're definitely not the same thing.
Got it. So it's a different way of looking at it. Let's go back to what I'm sensing is your expertise, which is value investing. Let's say you go through your initial set of screens and you come up with a list of a few hundred value stocks. What's the next thing to do?
So you want to go to the price first because that's what the anomaly is, right? And the next thing we would look at quality. With two equivalent cheap stocks, you want to actually hold the high quality cheap stock relative to the low quality cheap stock, because people kind of hate cheap, crappy stocks. So they tend to overlook the good quality of that cheap stocks.
When you say quality, maybe I'm just missing something. Do you mean quality of the product, quality of the management, quality of the industry?
Yeah, you can look from a lot of different angles, but we have like 10-20 ratios to look at. So, you can look at return on equity, return on assets. You can look on, margin stability. You can look at margin growth. We don't want to specifically look only on one ratio because it's not fair. So we want it to be very comprehensive. So we look at various ratios and combine them. And if the one has the highest, the combined score is what we call high quality stock.
Is there one particular ratio that weighs more in that you think is really more important to determine if a company is particularly high quality?
So what I said, like the margin stability and margin growth, like Procter & Gamble is for sure a good company, but the profit margin of Procter & Gamble is probably 50%, and they're not growing anymore because the base is pretty high now. But you can keep that high margin at a stable level. That means something. It's definitely a good quality stock. And on the other hand, like Apple, from 2004 to 2010, I think the growth rate of their margin is pretty high. Like they're growing every year, so that's certainly a good quality company too. But if you only look at the margin stability or margin growth, you're going to miss each other. So those two companies will be good examples of good quality companies, and we weight them equally, basically.
Mm-hmm. All right, let me give the standard disclaimer, and then we're going to wrap up. Regardless of the fact that Tao and I are talking about specific stocks, it is certainly in no way a recommendation for anyone. This is just an educational discussion to try to understand about investing. Make sure you speak to a qualified financial advisor before you do any investing. But Tao, I know that you guys are out there, and there's a lot more that you teach and talk about. So in the last few seconds, tell me, how can people follow you and follow your work?
Yeah, so I actually write articles in Chinese because I'm actually Chinese national. I'm not that active in the English world. The best place to find us is our website, alphaarchitect.com, and we constantly posting good ideas, good articles on our blog section. We also have some great guest bloggers that would contribute, on the contents as well. That would be the best place to find us. Okay, so we will put links to that at the show notes of today's show at goldsteinongelt.com. Tao Wang, thanks so much for taking the time. Thanks, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.